Hello, this is Charles. Thanks so much for taking some time to join me while I explain what is rental cash damming. If you watched my previous video on the Smith Manoeuvre, you may recall this term as being one of the accelerators. This particular accelerator can actually be isolated and run on its own. If you own a proprietorship, whether it be a home-based business or a rental property, you can use the cash flow dam accelerator to great advantage. Essentially, what the cash flow dam entails is first using the business's revenues to prepay the mortgage on your principal residence, the house in which you live, then reborrowing the same amount, and then servicing the business's expenses. For this video, I'll focus on a rental property as that does tend to be the more common use of this technique. It's important to note that this technique even works where cash flow is negative. Every situation is unique and worthy of investigation by your SMCP. To do the rental cash dam, you'll need a readvanceable line of credit. There are several lenders who offer this, though not all are equal. In this example, our homeowner owns their primary residence and one rental property. Their primary residence is valued at $1 million. They have a mortgage balance of $500,000. It's a 30-year amortization with monthly payments of approximately $2,710 at 5.14% interest. We assume a current marginal tax bracket of 40%. This means that for any debt you convert to a tax-deductible investment loan, you'll end up getting 40% of the interest back every year at tax time. The rental property is valued at $800,000. They have a mortgage balance of $500,000. It's a 30-year amortization with monthly mortgage payments of approximately $2,877. Annual rental expenses consist of mortgage payments, maintenance and insurance, and property taxes, for an annual total expense of approximately $38,734. This means you will have an annual debt conversion amount of $38,734. Now let's have a look at how this will work. You'll make the regular mortgage payments on your principal residence of $2,710. Your rental property generates income, and you have expenses to pay. It's critical to note that CRA does not dictate how you use your rental income. That's why this works. You would prepay the mortgage on your principal residence each year by $38,734, the total amount of expenses for the rental property. This means extra monthly prepayment of $3,227. Since now you have a readvanceable line of credit, this amount becomes available to borrow to pay the rental expenses. This means you're actually converting $38,734 per year of non-deductible debt, i.e. your mortgage, to deductible debt. And here are the results of doing this. The first thing we look at is how long does it take to move the full balance of the mortgage over to the investment line. We call that debt conversion, and depending on how many properties you have, it can typically take anywhere from 6 to 12 years to get there. In this case, debt conversion is achieved in year 7. Now, this doesn't mean that your mortgage is paid off. It just means that you've reached the point where your debt is completely tax deductible and you're getting your maximum annual refunds. The next thing we look at is the total value of the refunds you'll get from the program. This assumes the rate of interest is constant, your marginal tax rate doesn't change either. In reality, these things can fluctuate, but this gives us a sense of the kind of tax refunds we can expect to achieve using this strategy. In this case, the homeowner receives $132,000 in tax refunds over the life of the mortgage. Technically, you can do whatever you want with the refunds. You don't have to reinvest them into the program. But when we do projections like this, the assumption is that you'll use the refunds to pay down your mortgage faster. In this case, the net effect of using the tax refunds to accelerate the plan is you're able to pay off your mortgage 112 months ahead of schedule, which saves you $303,000 in future mortgage payments. When you take into account we make our mortgage payments with after-tax dollars, you can calculate how much income you'd need to earn to make those payments, which at a 40% marginal tax rate would take $505,000 in earned income to make those 112 payments. Next, we see the mortgage freedom date with the two scenarios: sell, and this takes into account capital gains, or hold the rental. This is when you will have been able to pay off your primary residence. Then the net rental value after just under 21 years, your mortgage freedom date. the future investment and rental value. And finally, since there's a payment savings as shown above, the assumption is you'll continue to make the monthly payment to the end of the original amortization. And since there's no mortgage to pay down, you invest those final 112 payments and earn a rate of return on them. In this example, we're using a rate of return of 8%, which is a very reasonable rate of return today. So the future value of the investment payment savings works out to $449,000, and you now have 2 free and clear properties, unless, of course, you decide to purchase another rental. Thanks so much for your time, and let's plan some time to speak about your own financial goals soon.